Expectancy is everything. Most people don't really understand what expectancy is, but this is what institutions are using and what professional traders actually look at to determine whether their edge is working over time and whether or not changes are positive or negatively impacting the model that they're trading. Okay, because positive expectancy is literally the definition of profitability. Everybody can calculate their own expectancy as long as you're actually journaling your trades, keeping your sizing uniform, which I'll get to in just a second. But basically, we want to find out our winning percentage. Okay, so say that 60% times the average size of our win in terms of R. So if we're risking 1 R on a trade, so say we're taking a position where we're entering here, and this is our 1 unit of risk. Our reward would be 3 times that, so 3R. Say over the course of 100 trades, our average when we are winning is something like 3.1 R. That's our average win. And we're taking this and subtracting it by our losing rate, which subsequently is 40%, multiplied by the average size of our loss, which should be factored in as -1. If we have 1 unit of risk and you're losing 1 R, then that should be your downside. Okay, so multiplied by 1. So we have 0.6 times 3.1. Okay, so now let's calculate this out. And I'm going to show you, this is really cool data, and you can do this for yourself and figure out where your trading's at. This is what you should be focusing on aside from all the other stuff. Expectancy is literally the number that you need to focus on. So if we have 60%, 0.6 times 3.1, that gives us 1.86. We take 0.4, obviously times 1 is going to be 0.4. So we have 1.86 minus 0.4, which is going to give me 1.46 as an expectancy. Now, say I'm risking $100 on a trade. That means that every time I risk $100 on a trade, whether or not I win or lose that individual trade, with these metrics, I know my expected profit on the trade is $146, whether or not I win or lose. This is expectancy. Now, if this is a positive value, you have a positive expectancy in a profitable model. But what you're doing is now basically collecting stuff in the market, feeding it into this data and figuring out if you have a positive or negative number and by how much. And then anything that you're adding, indicator or confluence, all you're doing is adding it to all of the data that you've collected and figuring out whether or not that pushes the needle forward for your expectancy or further away from your expectancy. And now you're only ever adding things that are statistically proven, which then allows you to focus on only execution that is going to impact your expectancy. It basically transforms the way that you look at trading rather than looking at it, I got to make a certain amount of money per trade. You're kind of removing all of that out of it and looking at it how algorithms look at it and how institutions look at trading, but with your human edge.